Good morning. It is Tuesday, June 2nd, 2026. This is your Deep Dive Daily Briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic and military posturing surrounding the Middle East peace process has entered a delicate verification phase. Following the official enactment of the Doha Memorandum of Understanding, International Naval Command Centers report that the temporary ceasefire between the United States and Iran has successfully held through its first 48 hours. However, the diplomatic focus has rapidly shifted to the highly contentious task of underwater mine clearance in the Strait of Hormuz. United States Central Command confirmed that while specialized Iranian naval units have begun deploying acoustic sweeping equipment, international observers have raised concerns over a lack of precise coordination regarding unmapped ordnance fields. Security officials in Washington have re-emphasized that any single maritime incident or unprovoked act of sabotage during this 60-day window will instantly void the agreement, keeping the entire regional security architecture on a highly fragile day-to-day timeline.
Transitioning from the tense maritime corridors of the Middle East to the broader global economy, the long-term structural scars of the recent energy supply crunch are manifesting in a profound realignment of international fiscal policies. In Paris, the Organization for Economic Cooperation and Development released its updated economic assessment, noting that the 3-month disruption of vital shipping lanes has caused a deep contraction in manufacturing productivity across advanced industrial hubs. The OECD highlighted that while the implementation of the ceasefire has provided immediate psychological relief to corporate executives, the cumulative inflationary pressures built into the supply chain over the past quarter will not dissipate rapidly. Industrial nations are now facing a severe deficit in essential chemical and manufacturing inputs, a structural bottleneck that is forcing policymakers to aggressively evaluate long-term national storage strategies and state-sponsored industrial subsidies to cushion domestic markets from future geopolitical shocks.
This sobering macroeconomic backdrop is driving a highly calculated response across international capital markets, where energy anxieties are colliding with the restrictive policy stance of major central banks. On Wall Street, major equity benchmarks experienced heightened volatility as institutional investors digested a stabilization of global crude benchmarks, with Brent oil hovering near $83 per barrel. This stabilizing trend reflects a cautious unwinding of the multi-month geopolitical risk premium. However, the sovereign debt market remains under considerable strain as the Federal Reserve, under the leadership of Kevin Warsh, continues to signal a prolonged period of monetary discipline. Financial authorities are advising market participants to brace for a sticky interest rate environment, as structural wage growth, increased regional defense outlays, and massive fiscal allocations toward domestic supply chain density continue to keep underlying core inflation numbers locked at elevated levels.
Turning our attention to the technology sector, this relentless push for infrastructure security is accelerating a monumental restructuring of global computational capacity to sustain the artificial intelligence boom. Industry reports indicate that global capital expenditure dedicated to high-density data centers is projected to approach historic thresholds by the end of 2026, transforming technological infrastructure into an instrument of core national competitiveness. To bypass traditional power grid limitations and avoid protracted regulatory permitting delays, tech conglomerates are aggressively accelerating their vertical integration strategies. The industry is seeing a major shift toward securing localized, self-sustaining energy systems, with leading hyperscalers funding advanced on-site modular power solutions to ensure that next-generation generative computing platforms can remain operational even in an era of deeper international fragmentation.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of international commerce, which are now absorbing the permanent structural costs of a permanently altered trade map. Despite the commencement of mine clearance operations under the Doha Agreement, major maritime carriers have finalized their operational schedules for the entire month of June, confirming that the Cape of Good Hope detour will remain the default route for all Asia to Europe trade lanes. Shipping executives warn that the physical process of verifying the safety of the Strait of Hormuz and reorganizing international fleet deployments will take several weeks to execute safely, meaning that maritime transport insurance premiums will remain elevated for the immediate future. Consequently, global enterprise logistics managers are finalizing a dual strategy, accepting high-cost regional inventory buffers and multimodal air-rail corridors as a necessary insurance baseline to guarantee supply continuity through the third quarter.
In summary, the global landscape is defined by the high-stakes implementation of the Doha ceasefire agreement as mine clearance begins in the Strait of Hormuz, occurring as the OECD warns of a prolonged inflationary pipeline from recent material shortages. Financial markets are adjusting to a cautious stabilization of oil prices alongside sticky bond yields, while the technology sector accelerates localized infrastructure to sustain the AI supercycle, and the global logistics industry commits to the high-cost African detour through the remainder of June. Based on the current trajectory, I predict that the economic relief generated by the Doha Agreement will materialize much more slowly than capital markets currently anticipate. The decision by major maritime lines to lock in the Cape of Good Hope detour for the entirety of June proves that corporate leaders are prioritizing operational certainty over political declarations. Furthermore, the deep systemic deficit in manufacturing raw materials built up over 3 months of conflict cannot be instantly corrected by a signed memorandum. Therefore, while equity markets may show short-term optimism, the Federal Reserve is highly likely to maintain a restrictive monetary posture with elevated interest rates for the remainder of 2026, recognizing that structural supply chain adjustments and the massive capital redirection toward energy-independent infrastructure require a prolonged period of monetary discipline.